This is Alex. He has $1,000 and wants to invest that money in the stock market. But he knows absolutely nothing about the market, so he's anxious. What if he picks the wrong stock and loses all his money? He could just leave his money in a savings account, but he had just heard from a guy on YouTube he shouldn't do that. But without any expertise, isn't it just like gambling? Fortunately for Alex, around 70 years ago, someone asked the exact same question and spent his entire life trying to solve it. Today, of course, most smart investors don't try to guess which stock will win. Instead, they follow a simple strategy. They invest in index funds and ETFs. But have you ever wondered why that strategy works? To understand this, we need to go back to the 1950s and meet the man who changed everything. Markowitz, the father of portfolio theory. The core idea behind index funds and ETFs is diversification, the strategy of spreading investments across different assets. Markowitz actually didn't come up with the idea. People understood this concept long before it had a name. Even Shakespeare hinted at it centuries ago. My ventures are not in one bottom trusted, nor to one place, nor is my whole estate upon the fortune of this present year. Clearly, even back then, the idea of not putting all your eggs in one basket was common sense. But for young Harry, common sense wasn't enough. He wanted a scientific and mathematical explanation of why diversification works and how to apply it to a much larger extent. And he did it. But before we dive into how Markowitz changed investing forever, we need to understand two fundamental forces behind every investment: risk and return. You see, the question is, how much could we gain from an investment, and how likely is it that we actually gain that much? Let's break it down with a simple example. Let's say an investment has three possible outcomes: a good scenario with a 25% of possibility of happening, in which you gain 20% return on your investments; a normal scenario with a probability of 50%, in which you gain 5% of return; and a bad scenario in which you lose 10%. Now, if someone asks you how much you expect to gain from this investment on average, what would you do? Well, you could simply multiply each return by its probability and sum them up, get 5%. This is the expected return, the average rate of return you might earn over time. In reality, professional investors use far more sophisticated models to predict return. That's where investment firms gain competitive advantage. But for now, Alex doesn't need to worry about that. He just needs to grasp the core idea. What if the same person now asks you, how risky is this investment? What we have to understand is how much each outcome deviates from the expected return. To measure this, we first subtract each return from the expected return, then square those deviations so they don't cancel each other out, multiply each square deviation by its probability, then sum them up. This final number, which is called the variance, tells us how much the investment returns fluctuate. To make it simpler, we take the square root of variance, which gives us the standard deviation, a single number that quantifies risk. But why should Alex care about all this mathematics? Because once you can measure return and risk, you can compare different investments. This was the key insight that led Markowitz to create modern portfolio theory. Through his research, he made two major discoveries. The first was that high returns come with high risk. He saw this pattern across all asset classes. Government bonds had low risk since they were backed by the government, but they also offered low returns. Corporate bonds, on the other hand, which carried slightly more risk, especially from small companies, offered high returns. This wasn't just true for investment, but for life in general. If you want bigger rewards, you have to take bigger risk. This became known as the risk-return trade-off. But his second discovery was unexpected. He wanted to see what happens to risk and return when different assets are combined in a basket. As expected, the total return of the basket was simply the weighted average return of individual asset returns. He assumed the same would be true for risk, but to his surprise, the combined risk was lower than the average risk of the individual assets. This was a breakthrough. So he tested different combinations: gold with stocks, real estate with bonds, railroad companies with agricultural companies, and found that the reduction in overall risk depended on how different the assets were from each other. If all the assets were from the same industry, like only railroad stocks, the risk reduction was minimal, but when he mixed them with, let's say, agriculture, the risk dropped significantly. This was the tipping point for his theory. Now he was onto something big. How could he find the perfect mix, the set of assets that reduced risk the most? What was the optimal portfolio? The reason for this risk reduction was simple. It came down to how different assets move in relation to each other. Imagine you own a business that sells ice cream and umbrellas. On sunny days, ice cream sales goes up. On rainy days, on the other hand, umbrella sales skyrocket, but ice cream sales drop. By selling both, your business stays more stable, because when one product struggles, the other one does well. Markowitz called this relationship correlation, which measures how two different assets move in relation to each other. We won't get into the math behind it, but here's what's important to know. Correlation is always a number between -1 and 1. The lower the correlation, the bigger the risk reduction effect in your portfolio. If instead of umbrellas, for example, you chose sunglasses to sell with ice cream, you weren't really diversifying for weather conditions. The same is true for investment. With this discovery, Markowitz completed his theory. He realized that risk comes in two forms. The first is systematic risk, which affects the entire market. Things like economic crashes or political instability. This kind of risk cannot be avoided no matter how diversified a portfolio is. The second one, on the other hand, is unsystematic risk. It is a specific risk to individual assets or industries and could be reduced by combining assets with low correlation with it. To visualize this, Markowitz plotted his findings on a chart, creating what he called the efficient frontier. Imagine you have 5 different assets, each with a certain level of risk and return. He discovered that certain combination of these assets minimize risk for any given return. These optimal portfolios all fall on the efficient frontier, showing the best possible trade-offs between risk and reward. This theory paved the way for index funds, which made investing available for everyone. Before, most investors had to beat the market by picking individual stocks, but index funds were designed to mirror the market instead, offering broad diversification and reducing stock-specific risk. The first index fund, launched by John Bogle in 1976, was built on these ideas. Today, his theories shape modern investing, influencing mutual funds, ETFs, hedge funds, and even robo-advisor. Now that Alex understands all this, he can return to his brokerage accounts and invest his $1,000 in index funds with much more confidence, knowing diversification is backed by science. But Alex also realizes that investing doesn't stop here. If he wants to take a more active approach, he can deepen his knowledge and look for information advantages to tilt his portfolio towards certain assets. However, he also understands that beating the market consistently is extremely difficult. Even professional investors struggle to do it over the long run. Still, whether he chooses a passive or active strategy, the foundation of his expertise remains the same: a disciplined approach to risk and return, diversification, and long-term thinking.